there's been a tension. There's been a tension between what have really been fantastic fundamentals, from a strong labor market to really incredible earnings numbers. But you've had this carousel of concerns. We've thrown everything you could throw at this market through the first 6, 7 months of this year, from inflation scares to Facebook privacy scares to flattening yield curves to trade wars. Market's still standing. Market's still standing. We think it's going to, we're set up for a very good back part of the year.
All right, so good back part of the year. It's a midterm election year. We've talked about the cyclicality that goes into that. The fundamentals on the corporate side are good. We've talked about this idea that there are corporate earnings, the microeconomic stuff that's driving markets. It's also trade and tariffs. It's also the Fed, central bank stuff. Of those three, which is the most important and which is the market going to pay the most attention to in the next 5 to 6 months?
Yeah, I mean, we've sounded like a broken record, but it's earnings. Earnings aren't just good. I mean, we all know that they're good. They're great. I mean, earnings are growing at the fastest rate in 8 years. Revenues are the fastest rate in 7. The beat rate, the number of companies beating expectations in Q2, is the highest we have on record. I mean, these are truly good earnings numbers. They will filter through because every day that the market stays flattish, and we're roughly up 6 or 7%, but roughly flattish, the market's getting cheaper. And I think one of the things that's really dangerous right now is there's this genteel notion that we all know that a recession's coming in 2 years and we're going to slowly make our way there. That's not how recessions work. Recessions occur when we're all euphoric. Look around. No one's euphoric yet. And so I think we've got a blow-off coming, you know, where inflation's going to be less than we expect. The markets are going to kind of melt up starting in the back half of this year, and then we'll start to lay the groundwork for the excesses that'll cause a recession later on.
So you're a portfolio manager that puts money to work.
Yeah.
How do you strategize? What's the game plan for how you kind of lay out your investments going towards the end of the year?
So from just a stock versus bond perspective, we came in thinking this was going to be a barbelled year with a very strong start, a lot of reasons for concerns in the middle months of the year, and then a strong finish to the year. So we entered the year roughly 50% overweight equities. We bumped that up to 80 when we got into those lows in February. We took some of those chips off the table earlier this summer because we could foresee some volatility. And we expect to put them back to work in the back half of the year as the inflation numbers continue to be benign, the Fed stays measured, and earnings continue to come through.